Hey guys, so in this video I'm going to be going over 4 stocks to buy in November of 2017. And this video will just be sort of the short main reasons why you should buy them, and then I will link to more in-depth analysis videos in the description, and I will put cards in the top right with links to all of the more in-depth videos. And I make videos on the stock market and investing, so if you're interested in that, consider subscribing, and let's get right into the video. So the first stock to buy in November of 2017 is Disney. And there are quite a few things that I like about Disney. They are struggling currently due to some issues with ESPN. They've been struggling since 2015, and that has caused their stock to go down quite a bit and be flat just about since the end of 2015. But I do think that they are going in the right direction. They are working on their own streaming service, which will be great. I think they definitely have enough content to back up their own streaming service, and they will be able to pull some viewers away from places like Netflix. I think that Disney's new streaming service will help them bring ESPN back, and it will help protect them from cord cutting. There is a lot of that going on, and that is hurting traditional TV, but with their own streaming service, I think that Disney will be able to fight that cord cutting and will continue to provide great content over the streaming service. And they should have done this a long time ago, I think. They have the content for it. And previously they were just allowing Netflix to profit off of their content, and now that they have their own streaming service, they will have the content creation and the content delivery, which will be great. It will allow another way for them to make some profits, so that is always good to see, and so I think that it is a good choice for Disney and that it will help them a ton in the long term. But like I said, they are going through a transition right now, so over the next couple years they could continue to trade flat. They also have a solid movie lineup in the coming months and the coming years, so I think that that will definitely help their movie studio segment, which was down quarter over quarter for the last quarter, but that's not a huge concern for me. They also have tons of strong brands. I can't think of a company that has stronger brands than Disney, with things like Star Wars and a lot of the other Disney movies, so that is another great thing for Disney. And then their parks and resorts segment has been doing very well recently, and I think that that will continue to do well. They've had definitely a lot of strong growth in cruises as well as all of their parks and resorts, and they're currently trading at a 17.3 price to earnings, which is great to see, less expensive than the overall market, and I think it's a pretty solid price for a company like Disney that has been a great stock over the last 10 or 20 years. It has grown quite a bit. And they have a relatively low dividend, around 1.5%, but this isn't an issue for me. I think it's great because it gives you a bit of money that you can reinvest in Disney stock, but it's not going to stifle growth for Disney because they aren't paying out too much of their earnings in dividends. So all in all, I think Disney's trading at an attractive valuation, and it is definitely a solid stock to consider buying in November of 2017. So then on to the second stock, it's Viacom. The symbol for them is VIAB. And Viacom, similar to Disney, is a content provider. They have TV channels like MTV, Nickelodeon, Comedy Central, and then they have Paramount Pictures as a movie studio, and they have quite a bit more, but those are some of the main ones. And I like Viacom because they are trading at ridiculously cheap valuations right now. They have a 7.2 enterprise value over EBITDA, a 7 price to earnings, and a 6.5 forward price to earnings. And they have been doing well recently. The last quarter or so, they were down about 78% since highs in 2014 or 2015, but I think they're starting to implement a turnaround. So they have ratings for most of their major channels up year over year. They closed their deal with Charter, which was a major issue about a week or two ago. They were down quite a bit, but they managed to sign an agreement with Charter to keep Viacom channels on all of the Charter TV subscriptions, and they currently have a 22% payout ratio with a 3.2% yield, so they have a solid dividend and a very low payout ratio. And then also they've recently been working to reduce their debt, and they've reduced their debt by around $2 billion in the last couple quarters, which is great to see. So all in all, I think that they're definitely pretty solid. They are a bit more risky since they are a smaller company with a market cap around $10 billion. Plus, they are going through a transition, and they have been struggling quite a lot recently, but I think that they will be successful in the end. They are opening up their own streaming platform with a few other content providers that are non-sports. So it'll be a new non-sports streaming platform, which I think will be great to see, because for people who don't watch sports, they're currently paying a lot of money to have sports channels included in their TV subscriptions, and this will get rid of that. So I think it definitely has a good chance for success with that. So all in all, I think that since it's trading at such cheap valuations, it is definitely worth buying a bit of Viacom stock. So then the third stock that I like in November of 2017 is ExxonMobil. The symbol for them is XOM. And they are the largest integrated oil company. I like that they're integrated because it means that they are safer than just an upstream producer. They are less reliant on the price of oil. So they have refining, they have chemicals, they have gas stations, and they drill the oil out of the ground. So they pretty much have every part of the oil production process, and that makes them safer. They currently have a 4% dividend yield, and they have raised their dividend every year for the last 34 years. So it's definitely a very safe dividend, I think. They have lower debt than most other oil companies, so that means that they're safer as well. So strong balance sheet, strong dividend. They do have some nice areas for growth, like opening some gas stations in Mexico. They have their Liza development, which they think can yield 10% plus discounted cash flow at $40 a barrel oil prices. And they recently purchased another aromatics plant, so that will help with growth also. And they have a newly purchased oil terminal in the Delaware Basin, which ExxonMobil says will establish it as a key midstream provider in the growing Permian Basin. So all of those are good areas for growth, I think, as well as I do think that oil prices could continue to rise. They have been on the rise for about a month, and I think that they could definitely continue with that trend, and that would be very beneficial for ExxonMobil. Though if oil does stay lower for longer, ExxonMobil will be okay because they are integrated and because they are very safe with their balance sheet and other projects that they're working on. And so finally, the fourth stock that I think is attractive in November 2017 is AT&T. The symbol for them is T. And they just came out with earnings, and they missed by 1 cent, and they missed revenue by about $400 million. And this sent the stock down about 4%. So I think this is a bit of an overreaction. And they're currently yielding almost 6%, and that yield is pretty safe. They're currently paying out around 70% of their free cash flow in dividends, so their dividend is definitely safe. And they have raised their dividend every year for quite some time. So I definitely think the dividend is safe. They also are currently trading at a 15.7 price to earnings and a 6.8 enterprise value over EBITDA with a nearly 11 forward price to earnings. So they're definitely very cheap on the valuation side of it. And they have reported in the most recent quarter the lowest ever phone churn for third quarter, so that is great to see. Their churn has been going down quite a bit recently, which is definitely good. It means that they're holding on to a lot of the subscribers that they are getting. And I think that's because of the bundling. When you bundle things like content with internet and phone service, they get a lot lower churn. And I also think that telecom in general is going to grow with things like Apple Watches and more connected devices that will need to have phone plans, so that will help AT&T. And then finally, they think currently that Time Warner is doing better than they expected, and that the acquisition will be done by the end of the year, so that will be good to see. It will add some debt, and they currently have $150 billion in debt, so they are a relatively debt-heavy company. I'm not over concerned with that currently, and they will be adding around $70 billion in debt for the Time Warner acquisition. But I don't see that as a huge problem right away. It will definitely be something to monitor if you purchase AT&T to make sure that they don't get swamped with debt. But I think that they will be okay in paying down their debt and maintaining their dividend. They have also done very well internationally, with international revenues up 11.7%, with mostly gains in Mexico and Latin America. And then in addition to this, they also have NFL Sunday Game Ticket on DirecTV for quite a bit longer. So that is definitely an added benefit for AT&T, because a lot of people who watch the NFL like to be able to get all of the games, and so they will use DirecTV. And then I also think that they are a pretty safe company, because I see telecom as a staples company. No one really goes without phone service. You need phone service to do just about everything now, so I would consider that a pretty non-cyclical industry. So that is good to see that they're going to be relatively safe, in my opinion, in the event of a recession, because people aren't going to stop paying their phone bill if there's a recession. They're going to cut other spending out of their life way before they cut their phone bill. And so those are the 4 stocks that I think are attractive to buy in November 2017. Leave a comment down below with your opinions on these stocks. I would love to hear what you guys think. What stocks are you guys looking at in November 2017? I would also love to hear that. So thank you guys for watching. If you enjoyed this video, make sure to like it and consider subscribing if you are interested in investing videos, because I make lots of investing videos. And have a great day.